Welcome to the Pathfinder Legacy Podcast, where we help farmers, ranchers, and business owners create a seamless transition plan for the future. From retirement to ownership transfer, we protect what you've built and guide you every step of the way.
Welcome back to the Pathfinder Legacy Podcast. I'm your host, Heidi Olson, and today we're diving into part 2 of my conversation with CPA Cory Wheeler. Welcome back, Cory.
Thank you.
All right.
Well, so long as we talked, it's good to be back on the show again.
All right. Well, thank you so much for being here. You had a lot of good tidbits of information for all of our listeners. In the first half, we talked a lot about some of those things that affect individuals. The second half, we're going to dive into a little bit more of where it's going to affect some of our entrepreneurs, our egg producers, and any of our small business owners. So I guess, Cory, at the top of your list, you had one of the changes that took place in that big, beautiful bill with the supplemental disaster. I'm trying to think.
Supplemental Disaster Relief Program.
There we go.
And I want to qualify this because this was not part of the one big beautiful bill. A lot of these things we're going to be talking about in this segment are just recent developments. It's not necessarily tied to that bill.
Okay. All right. Good to know.
And so what the Supplemental Disaster Relief Payment is, or SDRP, these are payments for 23 and 24 for disasters such as drought or flood or those types of things. We've had a lot of farmers get impacted by those because of the droughts and the low crop prices. FSA, this is all run through the FSA, and the FSA is making these payments out, and the payments are capped at $125,000. And so if you have benefits coming to you because of these droughts that exceeds that amount, then you might have to request a CPA or enrolled agent to give a certification on your funding. So even though we're capped at 125, we can get a waiver for that cap if we can show that 75% of your income is from farming sources. That 75% from farming sources is a little bit tricky because we're not looking at your gross sales. So you sold $1 million of wheat, but you had $1 million of expenses. So you had $0 from the farm is what it comes out to be. And so that's throwing a lot of things into chaos, especially since just a few years ago, we had some changes in depreciation laws and how we handle those trade-ins of equipment purchases. And because of those changes, if you have significant equipment purchases, that could disqualify you from getting this second payment because they don't view the equipment sales as a farming source of income. They don't consider that farm income. The sale of your cows, the capital gains there, those are fine, but not the sale of your drills. And so I've had cases where we had good income and this is an average of 3 years, I should mention that. And so for 2 years, we had good farm income, but 1 year we sold a lot of equipment and we bought it back. But because it's considered a sale of equipment, they were not able to qualify for the extra payment above the 125. So SDRP 1 came out quite some time ago, and I think most everybody has been paid on that. And they have now released a second SDRP program, SDRP 2. The way this program works is it's an addition to whatever we had before. So if you were one of these people that caught in the 75% of farm income because you had too much outside income, we don't get that 125 again. You're already capped. We've already met that maximum. But if you received 100,000 the first time, and now you're supposed to receive another 50,000 or another 100,000, then we might have to go through this process. The deadline for this process is they just came out with the deadline. Everything needs to be completed by April 30th of 2026.
Okay. So that's something for egg producers to make sure that they're watching those deadlines, marking their calendar, and talking to their accountants to make sure that they've got all the documentation and they've got the right numbers down.
And it's really important and it's really hard to do because what we do this year in 2025 won't have any bearing until 2027 if we have disasters in that time frame. So it's really hard to plan for what's going to happen and trying to meet those 75% funding requirements. One great thing is starting in 2026, I told you equipment sales weren't considered farm income. That has been modified for 2026. But the SDRP payments we're getting now is for 23 and 24. So if there's another program, it'll be for 2025. In that time period, we still won't be able to count the equipment. But starting in 2026, we will be able to.
Okay. So, Cory, how many of your, since we're kind of, having to go back in time, how many of your egg producers are you assisting quite a few at this because you've got some of you're also doing their bookkeeping and so forth for them, so you're helping to assist in that? Or are you finding more of the egg producers are using QuickBooks and keeping track of a lot of those bookkeeping items that they need to do right from their home office?
I'm seeing it about 50-50. QuickBooks is really pricing themselves out of the market these days. They're making everybody go to the online version, and I really do not like the online version. And I haven't talked to many accountants that prefer it that way. And so we're still trying to find a good substitute for QuickBooks. So we're in that transition period. I don't have good advice for you at this time as far as a good market.
Okay.
I'd say about half of my farmers do their own books, and half of them, we do the books for them.
Okay. So to be continued as we evolve, and there might be some other programs out there as you guys are researching to see what are some good substitutes to work into that for our specific businesses.
Yes. For the people that are already on QuickBooks Online, I do have this piece of advice. Speak to your accountant, because if you're paying the full amount for QuickBooks, there could be some discounts depending on what you're using it for. So when you generally sign up, it's going to cost you about $30 a month. But if you don't need accounts receivable or accounts payable, and all you're doing is using it as a check register, you can speak to your accountant. They can get you registered with something called QuickBooks Ledger. QuickBooks Ledger is $20 a month rather than $39. So you can get significant savings there depending on how you're using your QuickBooks.
Okay. All right. Very good. Now, moving on to our next area where, still with farmers and ranchers as we are getting into tax season and thinking about depreciation probably, or if we need to buy more equipment, or if something is already depreciated out, should we trade in or what have you? So you want to talk a little bit about the depreciation side of it and some of those pitfalls that can happen?
Absolutely. So in 2024, we were being phased down in bonus depreciation. And so this year would have been 40%, but that got changed in July with the One Big Beautiful Bill. Now we have 100% bonus depreciation, which means we can use depreciation to create losses. For farmers, it's really an important aspect to have, and it's really great that we got this back. One of the downfalls with bonus depreciation is that we can write everything off. What that means is if you buy a new tractor for $250,000 this year and we write the entire thing off to get your taxes down to zero. Next year, if you have to make payments on that tractor, next year we have no expenses to offset that depreciation. So when I'm doing advising, when I'm doing tax returns, I'm trying to advise you for the future. I'm trying to get you the most wealth, not the lowest taxes. So what I found works the best is if we have a 5-year loan on this tractor, let's depreciate it over 5 years. Then we're matching the payments to the cash. If you sold extra grain because the price of grain was so great this year, which it wasn't, then you have the extra cash on hand and you go out and pay cash for the tractor. We'll write the entire tractor off in 1 year. So I like to kind of match the payments to the cash flows, the depreciation to the cash flows.
Okay. Sounds good. Now, how about, go ahead.
I was just going to tell you that I've seen a lot of farmers go bankrupt by trying to buy their way out of taxes. So they'll get loan after loan after loan trying to get their taxes down. and then something happens and they have a hard time making these loan payments. But I have never seen a farm go bankrupt because they made too much money and paid taxes. Because if you're paying taxes, you're making money is what it comes down to. What I tend to tell my clients a lot of times is when you're spending money to get your taxes down, you're spending $1 in order to save 30 cents. So if it makes sense because it's a piece of equipment that you need and it's going to make you money and it's going to be a good investment, then by all means go out and get that piece of equipment. But if you're only doing it just to save on taxes, pay the 30 cents and put 60 cents in your pocket.
Well, and Cory, how many, you and I are kind of in this Bakken area where there's a lot of right-of-ways and easements and so forth and oil exploration. So, how many of these people have you seen over the years too, where they have all this income that has come in one chunk and they think they have to go continue to totally change out their inventory of their fleet or whatever they're farming with. And that income is temporary. And then they've spent it all. And now they're left with all these large payments and so forth. And they kind of put themselves in a pickle with that. We've seen that.
We've seen that a lot. And that comes back down to the whole philosophy of you have these big payments or these big pipeline payments come in. So you can use those pipeline payments to pay off whatever you're purchasing. But if you're putting it on a note, then you really shouldn't be doing that. You shouldn't. And pipelines are such a great tool to be used too, because there's a lot of different things we can do with pipelines.
Yep. That's a whole nother animal itself.
That's a whole other animal. That's a 2-hour segment, just what we can do with pipelines.
Well, we'll be to be continued on that one because there's a lot of things that we could do for that. All right. Anything else that you could think of on the equipment side before we move down our list of things? Anything else that you have for tips and tricks on equipment depreciation? Don't spend, just because you might have to pay some taxes in, don't spend down and create more debt for yourself.
Right. Because if you buy a piece of equipment that's going to rot in the yard, you're throwing money away. I'd much rather see you hold on to that cash and pay a little bit of taxes than to have a problem in the future or to just have it gone.
Okay. All right. Sounds great. Anything else that you could see for egg producers or small business owners on tax filing requirements or just some of those extra tips before we move into the estate side?
So one thing, and it's not so much for North Dakota residents because they have a low tax bracket to start with, but a lot of my Montana clients, with the Tax Cut and Jobs Act of 2018, it reduced the amount of taxes that we paid to Montana that's deductible on federal. It reduced it down to 10%, or I'm sorry, $10,000. And because they reduced it so low, just about everybody that used to itemize their itemized tax deductions didn't qualify anymore because they couldn't come up with enough tax deductions to exceed the $30,000 that they needed for a married filing joint standard deduction. And so what's changed with the One Big Beautiful Bill is it still has that cap, but they've increased it from $10,000 to $30,000. So now if you have $20,000 of state income taxes to pay, we can take that as a tax deduction. If we can add enough things like charitable contributions, home mortgages, we can add those back in to exceed the 30,000 mark, then we can take those tax deductions. We can also play games with how all of this flows its way through. So maybe we pay extra taxes this year in 2025 and then take the standard deduction in 2026 and not make our estimated tax payments and those types of things. And so there's different things that we can do in order to maximize our itemized deduction contributions as well.
Okay. Cory, would you say with making those estimated tax payments, so this might be a side note. So if you have someone that is required to pay estimates, but they don't pay them until do it in one lump sum or at the end of the year, do you see any sort of penalties or anything with that if they pay them more in a lump rather than paying them quarterly?
So you can ask me any tax question and I will always tell you depends. Depends is always the answer. So for farmers, as long as 2/3 of your income comes from farming, then we're not required to make quarterly estimated payments. So for farmers, we can make one payment in January, and that's good enough for them. And then they're good to go until April 15th when the tax returns are due. Another option for farmers is if they don't want to pay anything at all, they don't have to, as long as their tax return is filed by March 1st. But these days, the way 1099s are coming out and investment statements, it's really hard to get a lot of these tax returns done by March 1st because a lot of these statements aren't released until the last week or two of March. So for farmers, the answer is no, they don't have to make those payments. For regular business owners, it depends. I've advised this way. I said, well, what's your operating note? Because if they're going to borrow against their operating note to make these tax payments, they're better off paying the IRS. I don't have the IRS numbers at the tip of my fingers today, but I want to say they're about 7%. So if you're going to ignore your estimated payments, you're going to be paying 7% on that. So you need to either be making more than 7% and not pay those, or that needs to be a lower percentage than what you would borrow the money at. What I have seen and what I've done myself is, a farm, generally a lot of our farmers, they don't pay their wages until the end of the year to themselves. They don't pay their own wages until the end of the year. At the end of the year, they haven't made any estimated tax payments. And what's withheld on your W-2 is considered withheld all throughout the year. So basically what I'm saying is if you didn't want to make your estimated tax payments, you could make one payment in December, run it through payroll, and then have that entire amount applied to your federal income tax withholding. And then that's one way of not paying all throughout the year and not hitting those penalties. You won't be subject to those penalties at that point. So there's some benefit. There's ways of playing that game. I mean, it revolves around where are you spending your money and are you making enough off of spending it to save that 7%?
And just so many variables. So really making sure that you're getting the best advice from your accountant, CPA, who your advisors are, and making sure that you're looking at your whole entire picture. And that's a good reason for keeping your books up to date and not trying to be a shoebox accountant. I've seen families that they would bring into me for the end of the year, everything would be rolled up and just put in a shoebox, trying to figure out how to get through all those receipts and put them together. And there's no way that you're going to know where your numbers are at if you're not looking at them periodically.
Right. And it's very important to look at your numbers before the year ends, because there's a lot of things we can do to save on taxes before the year ends. Once December 31st hits, that's a cutoff. And there's a lot of things we can't do beyond that date that maybe if we would have known you were going to have a tax problem, we could have moved things around and adjusted things. But once December, if you only see your tax person once a year, it's not a good idea for a business or a farm.
Right. You need to be keeping in touch with them because so much can change and happen, even with the market, the economy, all those different variables. But one of the things that you may advise, and I've done some of this myself when I was working in the trust world, is making gifts. So many family members, they may, grandma, grandpa, or mom and dad, or what have you, they may want to do some gifting. So for Cory, you want to cover some of those limitations or exclusions? So
there's really two parts to a gift. There is the part where you file a gift tax return. And that is if you gift away more than $19,000 to any one individual. If you gift under $19,000, then the money is gone. You don't need to worry about it. Everything is done and taken care of. Keep in mind that when you're making gifts, you're gifting after tax dollars. And the person that's receiving them is receiving money that's already been taxed. So there's no tax deduction when you give it, and there's no taxes claimed when they receive it. So it's basically outside the realm of taxes, as long as it's under that $19,000 mark. Once we exceed that $19,000 mark. So if I were to gift to you $1 million this year, because I just like your podcast so much, I want to make sure that you stay.
Oh, thank you, Cory. I appreciate that.
So if I gift you $1 million, I have to do what's called a gift tax return. I will still not pay any taxes on that $1 million that I gave you. And you will still not have to pay any taxes on that $1 million I gave you. But where it changes is I'm allowed to either gift, or when I pass away, my estate can have, right now it's just short of $14 million. So I'm going to use $14 million as an easy number. So if I give you that $1 million, now when I die, my estate has to be $13 million or less. And right now, that's not a factor for a lot of people. But once we start factoring in things like mineral rights, property values, some of these farms can get over that 14 million mark. And that's where we start to become concerned and try to plan accordingly. One of the great things we have to plan for us these days is called portability. So in your situation, you have $14 million that you can have in your gifts or in your estate throughout your lifetime. One $14 million maximum. If you passed away, that $14 million that you had can transfer over to your husband. So now he'll have $28 million. But there's some paperwork that has to be involved with that. So make sure that these things are taking place and these things are getting done when you pass away.
Right. You have to record that with the IRS and making sure you're making those elections.
Right. We have to file a form called the 706.
Okay.
And then by filing that form, that's what gets us that portability election.
Any other items, Cory, that you can think of on the estate and gift tax limitations or preparation things that our listeners might want to be thinking of?
I think I've covered everything that's really changed. Every year, these amounts change. They're indexed for inflation. So this year, they're 14 million. Next year, they'll be 15 million. So they continue to increase. And for the most part, I've seen people worried to death about gifting to their children, and they're nowhere close to these estate limits. And I advise my clients that if you don't need the money, gift it to your children. Let them enjoy it. Once you pass away, you're not going to see how they can enjoy things. So let them enjoy it now when you can enjoy it with them.
Yep, that's very good advice, because that's something I would tell some of my elderly clients as well. It's like, yeah, you can hang on to it, but don't you want to see them enjoy some of these things during your lifetime instead of waiting? And you're not going to see that after they're gone and see the happiness and so forth that you can see from what the benefit your gift is making. Okay, so I just thought of something else with clients. If they're not gifting their $19,000 that they could give to any one individual and for decrease their taxable estate, is something else that they could do? Any charitable gifting, or if they were to medical or tuition payments that can help lower their taxable estate? If they pay, they've got a neighbor and they want to pay for generously all of their tuition expense, or maybe somebody ended up with a health concern and they have cancer and now they want to go ahead and pay all their medical expenses. Have you seen some of those things?
I have seen some of those things, and generally they're set up through trusts. And the way they can work is for the education trusts, for example, we can contribute, say, $60,000 for an education through a 529 plan. And even though that $60,000 is above the 19 we're allowed to contribute, because it's for education, we are allowed to spread that over multiple years. So we're giving $60,000 this year, but for all intents and purposes, we're gifting $19,000 per year over the next 4 years.
Okay.
And so there's some types of those things that can really help out as well.
And they could pay, if someone had a medical or college expense, as long as they paid it directly to the institution or the college, they get any sort of, does it work as a gifting for that? Are you familiar with that?
I am not familiar with that. Okay. I'd have to do some double checking on that to see how that would all work its way through.
Okay, to be continued.
To be continued.
To be continued, because that's something I was thinking about too while we were sitting here, is if you can do some of those additional gifting, if it's for medical or education. So, okay, well, for our listeners, we'll circle back to that one in the future. Other items that you can think of, Cory, on our checklist of tax tips and tricks for year end.
Well, I guess one more thing I should clarify with the gift tax is I said $19,000 per person. So that's $19,000 that you can give, that I can give you, $19,000 that I can give your husband, $19,000 that I could give to your kid, and then your kid can give it to you. All three of them. So I can give $19,000 per person, but then other people can gift it back to the person, the beneficiary that we wanted in the end anyway, as long as we trust that to actually happen.
Okay.
So it's $19,000 per person is the point here.
Okay. All right. And it has to be a completed gift, correct?
It has to be a completed gift. If you retain rights, so some people are gifting land to their children, but they're retaining the surface rights. That's considered an incomplete gift. That's not a gift, and it still is included in your estate taxes at that point.
Okay. And then with cash, if it's a completed gift, the form of that's being negotiated, whether it's a check or a wire or what have you, it needs to be completed, has had to have cleared and left your account to be a complete gift. So you no longer have control of that.
Correct.
Okay. Very good. Have you seen any other types of gifting other than cash assets, land, anything unique that you've seen from your clients that they've tried to gift?
If you can touch it or you can think about it, it can be gifted. I've seen mineral rights gifted. I've seen royalty rights gifted. So the owner retains the mineral rights, but somebody else has the rights to the royalties that come off the place.
Okay. Yep. It can be a big one too, because maybe they don't want the income. They don't want to have to incur that income, but they want to still have control of what the mineral rights are, but they're gifting the income away and not having to pay taxes on that.
Yep.
Okay. All right. Well, very good. Anything else that you can think of for today, Cory, or any additional items that we haven't covered? We've covered a lot of information and making sure that our listeners are clear on really who they need to be talking to and going through that checkbox at the end of the year.
Nope, I think I'm good with everything we've gone through. But again, I want to emphasize, I can't emphasize this enough. When you go to do your taxes for 2025, make sure that you bring your pay stub to your accountant. Your December pay stub, your final pay stub, is going to be very important for your accountants this year.
Okay, good to make sure that you check mark that and put it at the top of your list, mark it in red.
Exactly.
Okay, all right. Well, very good. I think we are just about out of time for today. So that wraps up part 2 of my conversation with CPA Cory Wheeler. I hope this helped take a little bit of the mystery and maybe some of the fear out of tax time for your farm, ranch, or small business. Remember, you don't have to do this alone. A good CPA who understands agriculture can be a huge part of your transition and succession team. If you'd like to keep learning with us, make sure you follow the Pathfinder Legacy podcast, share this episode with a friend or family member, and check out the show notes for links and resources from today's conversation. I'll make sure that I have Cory's contact information there again for you to connect with him. And at the end of the day, your legacy is more than numbers on a tax return. It's the story you're building for the next generation. Until next time, I'll see you between the ditches.
Thanks for listening to the Pathfinder Legacy Podcast, where your future is our focus. Be sure to subscribe, follow us on social media, and visit us at pathfinderlegacy.com to start building your transition plan today.